Hey, what is going on guys? My name is Nick, and if you're new to the channel here, welcome. In this video, I'll be discussing some of the best investing strategies that you can take advantage of if you're looking to invest your first $1,000 in the stock market right now. And guys, whether you have $100, $1,000, or even more than $10,000 to invest, it really doesn't matter. This video is still going to be directed towards you because it doesn't matter how much money that you're going to be investing. It's about the approach that you take towards investing to maximize those returns. Now, there are a multitude of ways to get started with investing in the stock market, with some being quite scary, to be honest, that I won't be getting into in this video. But in this video, I will be providing you with excellent methods that are proven to do well over the long term. So firstly, I just want to clarify that there's actually a huge difference between what is known as trading and what is known as investing. Generally speaking, trading is focused on the short term, which could be the span of a day or a month or even hours, whereas investing is actually focused on that long-term horizon where you're looking at years, if not decades. And as we all know, long-term investing has been able to create so many billionaires like Warren Buffett, Bill Gates, Jeff Bezos, among so many others, that simply proves why long-term investing is the way to go for most of us. So that will be the focus of this video today because I am personally a long-term investor. I do follow the types of moves that Warren Buffett does. So if you're interested, then stay for the video. If not, then you can click away. Now for this video, I'm assuming that you've already figured out how to open up a brokerage account, which is essentially an account that will allow you to trade stocks on the stock exchange. But if not, some quick suggestions for brokers that you can use in the US for free trading are Robinhood, M1 Finance, or Webull that offer really good platforms. And then the ones that I've opened up over here in Canada are Questrade and Wealthsimple Trade, with Wealthsimple Trade being a completely free trading platform. So with that out of the way, we're ready to start looking at some specific stocks and strategies to help you start investing your first amount of money in the stock market. And guys, if you do enjoy this video, make sure to tap that like button down below. It really does support my channel and brings this video out to more investors out there. And guys, if you haven't already, definitely consider subscribing down below and tapping that bell icon so you don't miss any of my weekly investing related videos. So without further ado, let's get into how exactly you can start investing your first $1,000 in the stock market. Now guys, starting off here with one of the safest as well as one of the most practical ways that anyone can get started with investing is through ETF investing or exchange traded funds. Now exchange traded funds are simply a basket of stocks, bonds, or commodities or other assets that trade as a single entity on a stock exchange. So basically, to keep it simple, they trade like individual stocks like Apple Incorporated on the stock exchange and actually have their own ticker symbols too. Now, typically an ETF will track the general performance of a market index like the S&P 500, which is the top 500 companies in the US. And the same can be said about different sectors like the technology sector or the banking sector. You can find ETFs for all of those. And that way, ETFs allow investors like you and I to invest in these groups of stocks rather than picking individual ones, which would involve higher risk. So it's important to note that with this larger diversification, you are getting a lot more security. However, it does dilute your returns because you're going to be including the losers as well as the winners in those groups generally. But if we look at the S&P 500, for example, over the long term, it does prove to have some very good returns, actually averaging out to about 10% per year before inflation. So that's really not that bad. And along with that, most investors can't even beat the market over the long term anyways, including all of the professionals in hedge funds and mutual fund managers. So it's almost better off to buy into one of these indexes and hold for the long term. Now, one great strategy to buy into ETFs consistently is through a technique called dollar cost averaging. And that involves buying in at regular intervals of time so that over time you are buying when the market is high, but you're also buying when it's low, and that ends up averaging out your position. But a lot of you guys out there are probably thinking, well, why would I buy when it's high? Why can't I just buy when there's a dip and then continue buying whenever it's a red day or whenever there's a dip in the market? And I actually found an article online comparing the difference between buying the dip and then dollar cost averaging with the S&P 500 over the long term, and it proved that dollar cost averaging was basically the best way to go because we can't time the market and we don't know when the biggest dip is about to happen. And oftentimes what happens most is that we'll be waiting for the next dip in the market, but it keeps rising continuously and we actually miss out on those gains. So it would have been better overall to start averaging into your position early. Now guys, in terms of the ETFs that I would consider buying for the long term, as you all know, I really like the S&P 500, and Vanguard has their own ETF. with ticker symbol VOO, which has a very low expense ratio, meaning you're not going to have to pay a lot in terms of expenses every year. But for those of you that are more interested in tracking all of the companies in the stock market and not just the top 500 companies, you can look at the Vanguard fund with ticker symbol VTI, and that tracks the entire US stock market. Now, the difference between these funds is that VTI is going to include a lot of the smaller capitalization stocks or the smaller companies, whereas the S&P 500 is only going to include those larger top 500 companies, which generally have bigger market caps. And overall, the performance of these funds over the long term has been stellar, with VTI sometimes beating VOO and vice versa. So really, both are a great option. So if you are looking to take a little bit less risk and diversify your portfolio amongst many different companies, but also still get those average market returns, ETFs are definitely the way to go. Alrighty, now getting into the second way that you can invest your first $1,000 in the stock market right now is by taking advantage of buying dividend-paying stocks. Now, these are simply companies that pay out dividends to their shareholders just for owning their stock, and so it's literally just a cash payment that goes into your brokerage account, typically on a 3-month basis. Now, a lot of investors out there are only looking for income, meaning they want that cash flow coming in every single month, and that's why they invest in dividend-paying stocks and diversify their stock positions so that they keep getting these dividends every single month from different companies. And not only that, but one of the benefits of investing in dividend stocks is that these dividends slowly increase over time if you're buying into companies that do increase their dividend payments. So it really is a hedge against inflation if you're relying on this cash flow every single month, because typically companies will grow these dividends over 2 to 3% per year if they are a growth dividend company. Now, with that being said, just because a company does pay a dividend and they have been paying it consistently does not mean that you should be buying into that without doing a little bit of further research. And there are some general criteria that I like to follow whenever performing an initial screening of many dividend paying companies, which I'll get into right now. So first of all, I like to pick stable companies that are very large and have been around for a long time, which is typically over 50 years in my personal opinion. The age and stability of a company is very important when you're choosing an investment because it shows that this company has held up throughout recessions in the past and probably will do so throughout the future. Now, the second thing to consider is the dividend payment history and how long that company has really been increasing and paying that dividend for. So for companies that have been able to increase their dividends every single year for over 25 years, they are coined the term dividend aristocrats. And then for those companies that have been able to increase their dividends for 50 consecutive years, they would be considered dividend kings. Now, thirdly, we want to find companies with very strong and resilient business models that will essentially be recession-proof and be able to continue paying that dividend throughout a hard period. Now, some examples of companies that actually do meet all of these criteria that I just spoke about are Procter & Gamble, Johnson & Johnson, 3M, and Clorox, among many other companies out there, but those are ones that come to mind. All of these companies are dividend aristocrats and have been able to pay those dividends consistently and increase those dividends each year for 25 consecutive years. So it does show the strength in their business models and that they'll probably still be around in the next 25 years. But aside from those criteria, there are some other technical criteria that I like to look at, such as the dividend yield, the payout ratio, and other things like that, which I've talked about in previous videos. So if you are interested, I'll put a link up here in the corner. And so definitely check that out. Alrighty guys, now the third great way that you can invest your money into the stock market, and that is through investing in growth stocks. Now, as most of us would expect, these are companies that are able to grow their earnings at a very rapid pace relative to some other companies in the stock market. Now, these are companies that may not have been around for a long period of time already, but they do have strong and resilient business models, which allows them to continue growing their earnings at such a rapid pace. Now, some examples of these types of growth companies would have to be Visa, MasterCard, Amazon, Apple, Facebook, Google, Microsoft, etc. So because these companies are able to grow these earnings so much faster than some other companies, they are going to be trading at a premium to other companies like dividend-paying stocks, which may not be able to grow as quickly. And as a result, that can typically lead to higher amounts of volatility in that company's stock price. So for instance, if they have a bad earnings report and analysts were expecting a lot of earnings out of that company and a lot of growth, but they aren't able to show that growth, the stock price could plummet. But on the other hand, these companies can experience significantly more gains in their stock price through capital appreciation when compared to a dividend-paying stock. And that is because dividend-paying stocks are typically paying out a lot of those earnings to the shareholder directly in the form of cash, whereas these growth stocks are reinvesting that capital back into their business to grow the share price higher and faster. So it's important to understand the risks associated with owning a growth stock in a recession, or if those earnings don't grow as quickly as analysts would have expected to. But in my personal opinion, if you are a younger investor, growth stocks might be a good option for your portfolio because your risk tolerance is so much higher and you do have a longer time horizon to recover if something bad happened. Alright guys, so having talked about these three different types of investments, the ETFs, exchange traded funds, dividend stocks, and growth stocks, I'll now be going through a scenario where I could potentially invest $1,000 into each of these different investments and how I would do it. But by no means is this going to be investing advice. I just want to make sure that you guys are doing your own research and making your own investing decisions. So anyways, one strategy could be to consider putting 50% of your capital into an ETF that tracks the general market performance like SPY or VOO or VTI, and then taking that dollar cost averaging approach to average your position down. So with only $1,000, 50% of that would leave you with $500 that you want to invest in this ETF. That could be VOO, and that would look like investing $100 per month to dollar cost average into that position. Now with the remaining $500, you might feel like you want to take a little bit more risk, and in that case, you can invest it into dividend stocks or growth stocks. And in that case, I would probably put like 25% into growth stocks and 25% into dividend stocks. But honestly, guys, it's really no problem if you want to invest 100% of your capital into a broadly diversified ETF that tracks the general market performance, because it probably will be just as safe. But with that being said, it really is sometimes fun to take a little bit more risk and bet on a company that you can see growing quite a lot in the near future. And so in that case, I would put about 25% into growth stocks and 25% into those dividend stocks. So I do just want to emphasize that this is simply one of many different investment strategies out there. I know many investors will get involved in value investing like myself, which I haven't really talked about in this video because it's a little bit more technical in nature. However, it's not so much about the investing strategy, but the types of companies that you're buying into. So buying into companies that you understand, that are large, that have been around for a long time, that either pay a dividend or they have highly increasing earnings. These types of companies will be around for the long term and are generally a safe bet. So with that being said, thank you guys so much for watching this video. I really do appreciate that. If you do want to let me know what you thought, if you are investing already, let me know down below. I will respond to basically every single comment. Also, let me know if you have any suggestions for future videos down below. I will try and get to the ones that are the top comments. So yeah, definitely let me know. So with that said, if you did enjoy this video, make sure to smash that like button down below and subscribe for more weekly videos on personal finance, business, and investing in the near future. And I'll see you guys in the next one.